So, what happens if we see a second Trump presidency? Well, it could mean a brand new global trade war. Now, if you're preparing for competitive exams here in India, you've got to understand the economics, the key terms, and the big strategic questions. Trust me, this isn't just a news headline. It's a core topic you'll see in international relations.
So let's get right into it. A new U.S. tariff war. What does it actually mean for India? And maybe more importantly for you, what are the key concepts and frameworks you absolutely need to know to nail your exams? We're going to break it all down.
All right, here's our game plan. We're going to tackle this like chapters in a textbook. First, we'll look at the timeline. Then we'll dig into the why and how behind it all. After that, we'll track the shockwaves it sent across the globe. And then, the big one, we'll explore if this is actually an opportunity for India. And of course, we'll wrap it all up with a quick revision slide, perfect for your notes.
Okay, let's start at the very beginning. How would something like this even unfold? You'll see that the sequence of events tells us a lot about the strategy and the chaos that would follow.
Now, this is a hypothetical timeline, but look at how fast things could move. It wouldn't be this slow, gradual shift. It's just boom, boom, boom. A series of rapid-fire announcements, retaliations, and then maybe a truce. It's this dizzying back and forth that creates something called policy uncertainty, and that's a key term we're definitely going to come back to.
So that covers the what, but now let's get into the why and the how. What was the actual reasoning behind these tariffs, and, how exactly were these numbers even calculated?
The official line, the one that was repeated over and over again, was all about one thing: reducing the huge U.S. trade deficit. The thinking behind this is that a trade deficit is basically a loss for the American economy, that it costs jobs at home because of unfair practices from other countries.
And when you look at the data, you can see why the focus was on China. I mean, it's the biggest source of the U.S. trade deficit, no question. But look closer. The European Union and Mexico are right behind. This shows you that the issue is actually pretty widespread. It's not just about one country.
And this slide right here, this is a crucial point for us. Look at India. Unlike China and Vietnam, India actually had a trade surplus with the U.S. But here's the kicker. India still got hit with tariffs. That really tells you just how broad this policy was meant to be.
Now, here's the thing that most economists will tell you. Tariffs don't really fix the root cause. For your exams, you absolutely have to remember this formula. S minus I equals X minus M. It's a fundamental rule of economics. A country's trade balance, that's exports minus imports, is determined by its domestic savings minus its domestic investment. The U.S. saves less than it invests, so it has to run a trade deficit to make up the difference. Tariffs are kind of like putting a Band-Aid on a much deeper issue.
And this brings us to another piece of key jargon you need to know: the reciprocal tariff. This was the specific tool they used. The idea was to create a unique tariff for each country that would, at least in theory, force the trade between the U.S. and that country to be perfectly balanced.
And this is the formula they used to do it. Now don't worry, you don't need to memorize this, but you should understand the basic ingredients. It calculates the tariff needed based on the trade deficit, using some standard economic assumptions about how demand changes with price and how much of a tariff actually gets passed on to the consumer.
So, to make this real, what happens when you plug China's trade numbers into that formula? You get this: 72%. That is a staggering number, right? It just shows you the sheer scale of what this policy was trying to do.
Okay, time for a quick exam tip. You might be wondering, how can a U.S. president even do this? Well, they have specific powers. And to remember them, just think of the word cite. S is for Section 232, which is used for national security reasons. I is for Section 201, to protect an injured industry. T is for Section 301, used against unfair trade. And E is for IEEPA, which gives them broad emergency economic powers. Cite. Got it?
So the U.S. makes its move. What happens next? Well, as you can probably guess, these tariffs sent immediate and powerful shockwaves rippling across the entire global economy. The connection here is really simple and direct. The cause was a massive spike in what economists call the Economic Policy Uncertainty Index. And the effect? Well, if there's one thing investors hate, it's uncertainty. So global stock markets immediately started falling as money ran for safety.
This slide really breaks down that chain reaction. First, the uncertainty index spikes. That causes investor confidence to just plummet. For countries like India, that means foreign institutional investors, FIIs, start pulling their money out. The result? Stock markets fell, not just in the US, but in Japan and right here in India.
At the same time, even the interest rates on safe U.S. government bonds went up, which is a really bad sign.
But amidst all this chaos and disruption, there's a huge question for us. Could this crisis actually create a strategic opening for India? Let's take a look at the potential opportunities here.
Now, this right here is a really key piece of data. While China was getting hammered with tariffs that went up to 145%, India got a relatively lower tariff of 26%. That difference, that gap in the tariff rates, creates an immediate price advantage for Indian goods in the U.S. market, especially when compared to Chinese products. So how do we figure out exactly where India can take advantage? For that, we use an economic tool called Bilateral Revealed Comparative Advantage, or BRCA. Now, for your exam, don't get bogged down by the name. Just think of it as a score. If the score is greater than 1, it means India is already a better-than-average exporter of that product to the U.S. It's where we have an advantage. And when we use that BRCA analysis, a few high-potential sectors really stand out. And guess what? We've got another mnemonic for your notes. Just think tactful exports. T is for textiles and apparel, where India has a strong BRC score. A is for agriculture. C is for chemicals. And the final T is for technical articles, like things made of iron and steel. These are the sweet spots where India can really push to gain market share. Okay, we have covered a ton of ground, so let's bring it all together. Here are the most essential points you need to take away from this whole analysis for your exam prep. First, the main issue. The U.S. tried to fix its trade deficit, but tariffs don't fix the deeper structural problem of the savings-investment gap. Second, the key term to remember is reciprocal tariff. Third, the biggest global impact was the massive spike in policy uncertainty, which caused all that market chaos. Fourth, India's strategy should be to use its high BRCA in those tactful export sectors. And finally, a big critique of this whole policy is that it ignores how modern supply chains or global value chains actually work. A so-called Chinese product might have parts in it from America or Japan, so the tariff ends up hurting everyone.
And that brings us to our final thought. During the first trade war, countries like Vietnam really benefited as trade got diverted away from China. So the question now is, if it happens again, can India go a step further? Can we turn this crisis into the strategic opportunity we've been waiting for to become a real, genuine alternative to China and global supply chains? That is the billion-dollar question for India's future.